Hello everyone, I'm Mark Sain and welcome to Sain Investment Solutions. Before we begin, please take a moment to pause this video and review the following disclaimer. Thank you for that. Today is week 3 of the Forex market review. We're going to look at the DailyFX news as well as 2 currencies, and then also have a look at one of the currencies which was affected by the oil. So as the oil devalues, that country's currency devalues, which allows us to trade it in a good direction for ourselves. So let's first take a look at the DailyFX to see what news has come up and what's coming up in the future. So here we have is a DailyFX calendar. What you can need to do first is click on the filter, which today we're just going to filter on the high importance news. And then we're going to also just click on the GMT time and just go down to your local GMT time. I'm going to be using the Australian Eastern States GMT time, and you'll just need to adjust this for your local GMT time. As we can see, we have today's news. Today being Wednesday the 20th of January in Australia. If we go back to, or if we click on the weekly view, we should be able to see what's happened at the beginning of the week and what's likely to happen for the remaining parts of the week. The week starting on Monday, January the 18th, we saw USD holiday. So the United States had a holiday, and they had the holiday for the Martin Luther King Jr. And that's just to celebrate his efforts that he did, along with the black and the white community forming a relation and marching down the streets for equal rights for all, and that's something we should remember, because all of us get what we have today based on that one famous guy. So we're going to thank Martin Luther King Jr. for that, and for our freedom that we have this time and these years. As we progress further on Tuesday, we see some news come in. We had some China GDP numbers come in. We had some pound consumer price index numbers, and as well as in the pound, Mark Carney spoke in London. As you can see, the Chinese GDP numbers forecast for 6.9 came in at 6.9, which was pretty good, and the CPI numbers for the pound with 0.2 coming also in at 0.2. If we progress down further, on Wednesday the 20th of January, we had the New Zealand CPI numbers coming in. That was forecasted at 0.3, but that came in as worse than expected at only 0.1. We also, this Thursday, the January the 21st, which would be tomorrow, if we look at what's coming up tomorrow, we've got the USD Consumer Price Index numbers. So we're looking at 0.8. So we want to see that number around the 0.8 or better. That way we're going to see some growth in the US dollar. If we see the number worse than expected, you expect to see some poor results and the US dollar lose some ground. We also have the Canadian interest rate decision coming up. That's likely to remain unchanged at 0.5%, as well as the European Central Bank rate decision. That's also likely to remain unchanged at 0.05%. Moving on to Friday, the 22nd, Australian Eastern States time, around 18:45 is the Euro President Draghi speak. Now, this is probably going to move the euro a little bit, depending on what he has to say with the market. And wrapping up for the rest of the week, ending early mornings of Saturday in Australian Eastern States time, we have the Canadian CPI numbers coming out. And again, we're forecasting 1.7, so any numbers around 1.7 or higher will have some strength in the Canadian dollar, as well any lower numbers will see it fall. One of the currency pairs we'll look at will include the Canadian dollar, and we will look at that pair because the Canadian dollar is heavily affected by the oil. So while we see in the past few weeks and months the oil devalue, you'll see other currency pairs reflecting against the Canadian dollar would likely increase in value. The first currency pair we'll look at this morning is the Aussie USD. So we're going to start on the Aussie USD on the daily time frame, as we can see up here. And what we've seen in the past week and a bit, we've seen a decline in the Aussie dollar versus the US dollar. Now we have also seen the stock markets fall in value, and normally when the stock markets fall in value, you'll see people jump to safe haven currencies, and generally safe haven currencies have been the United States dollar, the Japanese yen, and the Swiss francs. So as the Aussie dollar is weakening, we'll see a bit of strength in the US dollar. So what we can see if we look down in this time frame around this corner down here, we can see what we look like. We see some wave patterns happening. We look like we've got a wave 1, pull back for wave 2, and down for wave 3. So what we want to do is just firstly just drop in some support and resistance levels. So we'll just go ahead, we'll grab our tool and just drop them in roughly where we think they might be. So as we can see, that sort of bounced there a few times, so that's going to be our first support area. We can also zoom out to a higher time frame, maybe even zoom out a little bit more just to check to see roughly where they line up. And then we can just adjust them accordingly. So if we just pull these levels down just roughly where they've bounced on a higher time frame a bit more, we can see it's likely to find support around these levels, and then again around these levels down here. So that just gives us a indication of roughly where we think it may go based on support and resistance. Another tool that we like to also use to predict the support and resistance areas is the Fibonacci expansion tool. And what we'll do prior to that is we'll just draw in some wave cycles. So what we'll do is we'll just put a text there and we'll just call that wave 1, and then we had to pull back down for all of wave 1 to start of wave 2. So this is wave 1 down here, the pullback for wave 2, and followed by wave 3 cycle down again lower. Now this is wave 3 cycle all the way down here. Now as the AO comes all the way back to the 0 line, that then we'll know the end of wave 3, and we should have seen a bit of a pullback for wave 4. So while we're predicting how far this could go, what we want to do is use the Fibonacci expansion tool. Prior to that, before we take our entry, we draw the high of wave 1 to the low of wave 1, or the start of wave 2, and wave 2 pullback will pull back roughly around 61.8% level. So if we drop a line in around the 61.8% level, and then we go ahead and remove the Fibonacci retracement tool, if we roughly got in at these levels here, put our stop losses above the highs, we're probably looking at around 125 pips stop loss. And so when we want to make our risk to reward, we want to make a minimum of 1-to-1 is where we look at possibly bring it to break even. We always want to win more than we lose. So we want to try to make double that. So down to the bottoms down here, we could make another 170 pips. So if we're risking 125 pips, we can easily make our minimum 1-to-1 at these levels, and that's where we would have considered bringing them to break even. So while we're in the trade, we would then go say to ourselves, well, where do we expect the market to go? Now we've already drawn in support and resistance areas based on a higher time frame, but what we want to use is this tool here, and this tool here is called the Fibonacci expansion tool. And what we do it from the highs to the lows, back to the recent highs, and it has a prediction of roughly where it can go. The first place, the Fib expansion 61.8% level. The likely area it will stop, and it generally does, is the Fibonacci 100% level. But sometimes we see it push all the way down to the Fibonacci 161.8% level. Now, due to the stock market falling, we've seen a big decline, and that's why it's pushed all the way down here. But what we've seen, it's come down, it's found support at the 61.8, had its bounce up higher, then crossed back through, came back down, fell through this 100% level, bounced back higher, then back down, and it's struggling, trying to poke its head up, but would still be in the market because it hasn't closed back above this 100% level, and then it's fallen back down to the 161. So it's around about this level here where we would be looking at getting out and taking our profits, definitely down by these levels here. Now if you were risking 125 pips, even if you chose to get out safely at the 100% level, you could have easily made 240 pips, which is almost 1 to 2. So you risk $100 to make $200, and that's a great bet. There's no reason why you need to try to push it lower. Save some of the run for somebody else. But if you happen to stay in the market, then you would have done very, very well. Now here we have is the pound CAD. So up here we can see we're on the pound CAD daily chart. And as indicated, we're going to look at the pound CAD because as the oil decreased in value, the Canadian dollar would have fallen in value, and as a result, the pound would have increased in value. And we have seen a increase in value as the oil's been falling and Canadian dollar's been falling. We've seen a nice run up in the pound. So what we're going to do is look at the daily chart. We look for some wave cycles. So what we can see is if we grab our Fibonacci retracement tool, if we look at the start of 1 to the end of wave 1 and the pullback for wave 2. So here's the beginning of wave 1 all the way down here. Then we have the end of wave 1, which is the start of wave 2. And then the end of wave 2 and the start of wave 3. And then the end of wave 3 and the start of wave 4, and our fifth and final wave starting here. So looking back, wave 1, pull back for wave 2. Wave 2 comes back to roughly around the 61.8% level. The reason why we like to use this level is because our risk to reward. So we want to make sure that if we're exiting down these lows here of about 700 pips, we want to make sure we can make the same pips before we get back to the highs again. So risking 700 pips to make at least 10,000. So we're looking around 1 to 1.5 is our minimum target. What we then do is remove the Fibonacci retracement tool and we put on the Fibonacci expansion tool. So from the recent lows to the recent highs and then back again. And what that does is that gives us an indication of roughly where we think the market will go. So as we entered the trade at these levels here, we had the stop losses down here, and let's say we had them at even 750 pips. We've seen it rally up. It's reached these levels up here. It's come to what would have been a double top back here, and we would have said to ourselves, well, we've made at least 1 to 1. Let's bring our stop loss to break even. So we would have moved our stop losses from down here all the way up to break even, which was there. What we then do, we then hold the trade, and we're losing no money because our stop loss is there. If it was to come all the way back down and stop us out, we would have got break even and we would have lost no money. We then go for our trade and we'll try to make 1 for 2, and therefore we would have risked 750 pips to make 1,500, and we've already easily made 1,500 at the 100% level. So as it's come up, hit the 61.8% level, had a bit of bounce back, we've moved our stop loss to break even, it's rallied up, broken straight through the 100% level, where we would have taken our targets, would have made risk $100 to make $200. However, if you stayed in the trade and you followed all the way up to the 61.8% level, you would have easily made a lot more. So risking 750 pips and making up over 2,500. Now that's a good risk to reward, and that's why we always like to do risk versus reward. We want to make sure that when we win big. What we then want to do, we want to look at the wave 3. If we want to look at another entry, we then look at a pullback of roughly wave 4. Wave 4 is about 38.2% to 50% level. As we can see, it's come down, bounced between those levels there. So let's just take an assumption we entered on the earliest fib, which is 38.2. We then remove that tool. We then put our stop losses somewhere, down these levels down here, where it's likely to come back and maybe find support before bouncing higher. Now, if we were risking, what we always want to look at is look up higher. So I want to get out before these double tops. So we want to get out before there, and so we're going to risk 400 to make 1,000, and easily we made 1 to 2. So that would have been another great trade. That was week 3 of the Forex market review. I'd like to say thank you and I wish you all the best to your success. Take care.